Hi, I'm Norm Plumstead, the President and CEO of Honor Bank. Welcome to the fourth video in my 10-part series on demystifying banking. Today I'm going to discuss the Deposit Insurance Fund. Let's start with a brief history of the fund, which is closely linked to the FDIC itself. During the Great Depression, bank failures were widespread. In fact, about 40% of U.S. banks disappeared between 1929 and 1933. The banks that survived became extremely cautious and were very reluctant to lend. So in response to the crisis, the U.S. government created the FDIC. At first, the FDIC offered temporary deposit insurance that only covered up to $2,500 per depositor. Then in 1934, when the FDIC became a permanent agency, the limit was raised to $5,000. The limit was gradually increased over time. For instance, it was raised to $10,000 in 1950, $20,000 in 1966, $40,000 in 1977, and $100,000 in 1980. Most recently, it was bumped to its current level of $250,000 in 2010, following the temporary increase to that level during the financial crisis of 2008. So how does the Deposit Insurance Fund work? Well, it's funded primarily through insurance premiums paid by banks. The amount that each bank pays is based on a percentage of its deposits, and the rate varies based on the institution's financial health and therefore the risk to the fund. The FDIC assesses each bank's risk to the fund and assigns it a risk category. Risk factors considered include the institution's capital levels, its loan quality, and its management practices. So different banks pay different amounts based on their deposit size and risk profile. If a bank fails, the FDIC steps in as a receiver. After being appointed a receiver, the FDIC has two primary ways to handle a failed bank. The first option is for the FDIC to pay the bank's depositors up to the insurance limit. Alternatively, in what's known as a purchase and assumption transaction, it arranges for another bank to take over the failed bank's deposits and some or all of its assets. The latter really is the FDIC's preferred method, as it's typically less costly and less disruptive for customers. The FDIC monitors and reports on the fund's balance relative to the total amount of insured deposits in the banking system. And if the fund's balance drops below its statutory minimum, the FDIC can increase the insurance premiums to replenish the fund. Which brings us to the present day. The FDIC estimates that the failure of Silicon Valley Bank will cost the fund about $20 billion. Signature Bank's failure will cost about $2.5 billion, and the cost associated with First Republic is estimated to be about $13 billion. So to fill that $35.5 billion hole, the FDIC has proposed a special assessment to be paid by banks in excess of $5 billion in assets, and is going to be based on the amount of uninsured deposits the bank held at the end of 2022. So that fee would only apply to around 113 of the largest banks in the US. And in practice, it's banks with total assets of $50 billion or more that will end up paying about 95% of the special assessments. Banks such as ours and every other bank in Michigan for that matter with assets less than $5 billion won't have to pay any fee. So you've probably heard or read proposals to potentially increase the amount of coverage beyond $250,000. It's certainly been done before, right? Well, in May of this year, the FDIC proposed raising the limit for businesses and leaving it as is for individuals. However, it's ultimately up to Congress to raise the limit and there doesn't seem to be any consensus as of yet. So let me leave you with two practical takeaways. First, it's important to understand that deposit insurance is $250,000 per depositor, per FDIC insured bank, per ownership category. What does ownership category mean? Examples of ownership categories include single accounts, joint accounts, certain retirement accounts, trust accounts, business accounts, as well as government accounts. So the FDIC insures deposits according to the ownership category in which the funds are insured and how the account is titled. So this means that deposits held in different ownership categories are separately insured up to at least $250,000, even if it's held at the same bank. Included in this post's description is a link to deposit insurance FAQs. This FAQ also includes a tremendously useful FDIC insurance calculator. I encourage you to go there and check that out if you've got any questions about your coverage amounts. Of course, pick up the phone and call your banker to make sure that you're getting the most amount of coverage available to you. Second, banks, including Honor, offer what's known as reciprocal deposit arrangements. Think of these like FDIC insurance sharing programs. It's suited for some high net worth individuals, certain business accounts, municipalities, and other public fund organizations. If you're interested in learning more, please give us a call. Share your questions or comments below. Reach out to me directly on my cell phone if you'd like, either via calling or text at 231-709-1730. I appreciate you watching this video, and I'll see you back here next time.